I am going to start into the fascinating topic of federal income tax. And there's X through Wyoming because y'all don't have an income tax. Gains or losses on timber. If you sell, I'm going to make a big deal about differentiating a sale of stumpage, standing trees, and selling products that are cut from the standing trees. So in the case of stumpage, your gain that you may owe tax on is whatever you're paid for the stumpage less the allowable basis. Now the allowable basis is the same as depletion allowance to most folks, but I'm a nitpicker, so I make a distinction between that and depletion allowance. If you or someone that you contract with to cut your timber and you don't give them the proper rights in that timber, the income that you receive from the sale of the timber is only going to be receive capital gains treatment if you use a special provision that I'll talk about. But basically, if you sell cut timber, it's whatever you get for the products minus the cost to do the cutting minus the depletion allowance. And I still make a differentiation between allowable basis and depletion allowance, because if you're having a conversation with a friend that's in the oil and gas business, they may think you're getting the kind of percentage depletion that they're getting from their wells, and you are not. You timber owners, timber only qualifies for cost depletion. So the depletion, the cost basis of your timber becomes very important. So it's the basis in your timber that determines how much you can take off if you sell the timber on the stump, and how much you can take as a depletion allowance if you harvest it or have someone else harvest it. We start out with the original basis, and there's three basic ways to take title to timberland. There's a purchase, an inheritance, or a gift, and the rules about what that original basis is significantly different for those three, and those differences can play into how you consider transferring your property to the next generation. And what I'm talking about here applies to both land and timber. If you purchase it, your original basis is the acquisition cost. Acquisition cost is your purchase price plus whatever expenses you had in order to take title to the land. So you may have paid an attorney to get involved, and sometimes the buyer ends up having to do what the seller should have done, and that is have a survey done. If someone inherits your timberland, whether or not it's a member of the family or not, the person inheriting it gets a step-up basis. The basis is stepped up to the fair market value on the date that you die. And if you think about that, that means that over that period that you owned that land, it was increasing in value. If you sold that land the day before you die, you're going to pay income tax on it. And that after-tax income would then be part of your estate and could go to the kids. But if you leave it to them as an inheritance, and by inheritance we're really referring to any kind of testamentary transfer, there's some legal matters that get involved there, and I'm not an expert on that. But if they inherit it, the basis of that property is the fair market value on the date that you die. If it's a gift, there's something called a carryover basis that applies, and that means that you, as the parents, have a basis in this property. If you give it to the kids, their basis is your basis. If you have to pay a gift tax, which is highly unlikely, there would be a proportional increase according to the gift tax that was due on the amount that property increased while it was in your hands. So if you sell timber, you can only recover the basis in the timber. You can't recover the basis that should have been allocated to part of the land. So it's basically a simple process if you have the information that's needed. So assume that you purchase 100 acres and you pay the seller $115,000, and you have an additional $5,000 of related expenses. So your acquisition cost is $120,000. And let me go through this table. So we have the assets that you acquired for that $120,000. You have the land, the timber, and the improvements. The tricky part here is that you have to estimate the fair market value of that land as if it was sold completely separately. That's why I referred to bare land value earlier this morning. Then you have to estimate the fair market value of the timber, and then the fair market value of the improvements. And so it's analogous to, this is strictly hypothetical, of course, but selling each of those three assets separately. You add up the fair market values of all of those, and in this example, that's $150,000. So the $150,000 of the three assets is greater than the $120,000 that you paid. Your basis cannot be greater than $120,000. So you take the fair market value of each of the assets, you divide it by the total fair market value, you get a percentage, and of course that percentage adds up to 100. Then you multiply the total basis, $120,000, times those percentages, and you get $36,000 for the land, $64,000 for the timber, and $20,000 for the improvements. And so these are the individual bases for those assets. You only get the basis back in the land if you sell it. If you sell the timber, then you're going to be recovering this $64,000 in proportion to the amount of timber that you sell at any one time. So that's the original basis. Now we have to deal with the adjusted basis, and there may be some changes that have occurred in that basis since you originally acquired the property. The adjusted basis is the original basis plus improvements that you may have made on the property. So if you put in a road, especially an improved road, that would become part of the basis in the land. You may put in a reservoir or whatever. You would reduce the basis by any basis that you previously recovered. Like if you have one timber sale and you forgot to claim the allowable basis on it, and then you have the second timber sale and you now know about basis recovery, then you would have to reduce the original basis by the basis that you should have claimed when you had that first timber sale. The timber accounts, there's two accounts for the timber itself. There's the dollar basis account, and you also have to keep track of the volume of timber that's on your property in the year that you have a sale or other disposal, such as a casualty. And quite simply, the allowable basis is determined by the depletion unit, which is the adjusted basis divided by the current volume. So if you're selling timber and you have somebody helping you with the sale, or even if it's you're dealing directly with the company that's going to cut the timber, you need to get them to estimate the total volume of timber that's out there, not just the volume that you're going to be selling to them. So you get a depletion unit, dollars per 1,000 board feet, and you get the allowable basis then simply by multiplying that depletion unit by the number of units, and that gives you an amount that you don't have to pay tax on, because that's what you paid for the property, for the timber. As an example, carrying on with that first example, we have an original basis of $80,000. We have some improvements that were made to the timber, like a timber stand improvement, or y'all are doing some fire protection type activities, I believe, and so if you are not able to expense the costs of cleaning out the Douglas fir or getting rid of the woody debris that's a fire hazard, you could add those costs to the basis in your timber. So let's assume that that happened and you now have an adjusted basis of $90,000. And the current volume of merchantable timber on your 100 acres is 1,000,000 board feet, 1,000 board feet. Your depletion unit is $90,000 divided by 1,000, 1,000 board feet, so that's $90 a 1,000 board feet. And if you sold 600 of that 1,000 board feet that's on your property, you sell it for $110 a 1,000. Your gross proceeds are going to be $66,000. Your allowable basis is going to be that $70 per 1,000 depletion unit times the number of units you sold, which will be 42,000. Your selling expense is $4,000 because you hired a consulting forester to find a market for you. So what you pay tax on, capital gain, generally long-term capital gain, is $66,000 minus $42,000 minus $4,000, which is $20,000. So if you didn't do any of these kind of calculations or didn't know the basis in your timber, you'd be paying tax on $46,000. You'd be paying tax on $46,000 more than you would have otherwise. You'd pay tax on $66,000. I'm going to talk about using that basis then in relationship to losses. And when it says non-operating losses, that means it's not a business loss. It's a loss like a casualty loss. Casualties. I'm going to give you some bad news about your infected timber here in a minute, but I'll first explain why. To have a casualty loss, the event, the tornado, the fire, whatever it is, has to be sudden, unexpected, and unusual. Suddenness generally means it happens quickly, and in the IRS code, interestingly enough, they refer to airplane crashes into your house as an example. Unexpected means that you didn't know that the mountain pine bark beetle was coming your way, and so you didn't expect it. But it's hard to, with a straight face, tell the IRS you didn't expect it. And it has to be unusual, and in your area, as the pine beetle marches eastward, it's not unusual. There's a second category, which is similar to a casualty loss, but if you have business property and you have a loss, it doesn't have to be due to a sudden event, but that event has to be unexpected and unusual. That's very rare. It used to happen in the southeast with the beetle they have down there. The amount of a loss, casualty loss or otherwise, is the change in the fair market value of the timber that's destroyed and the basis of the timber that's destroyed. If you don't know what your basis is, the basis is zero, so the basis that you're comparing to the change in fair market value is zero, so you're not going to have a loss. My interpretation then is that the mortality due to the mountain pine bark beetle is not a casualty or not a business loss. And if someone wants to claim that it is and take it to court, you may win, but it's highly doubtful. Your option then is to have a salvage sale, and obviously that means that you need to sell it while the trees are still saleable, and you got to find a buyer, and apparently that's somewhat problematic, but the best you can do is to give it a try. Otherwise, you're just out of luck. The gain on a salvage sale is determined as with any other gain, but that gain is reported differently than it would be for a voluntary sale transaction. This is called an involuntary conversion. And so whether or not your timberland is part of a business, it's reported as if it was a business property. And it goes not on Schedule D, but on Form 4797, which is where you report the disposal of business assets. And if somehow you have a basis that's higher than what you received for the timber when you sold it, which may be quite possible, given the very low value, I assume, for the trees killed by the mountain pine bark beetle. If you have a loss, when you calculate your gain, that loss is not going to be subject to the $3,000 limit that applies for personal losses. Like if you sell your house at a loss, the maximum amount you can claim is $3,000. And in addition, the tax on the gain, if you have a gain instead of a loss, when you take the proceeds from the sale and subtract off the basis, you can take that gain and postpone it by acquiring replacement property, which is kind of nice. To be qualified as replacement property, it has to be like kind, so in this case that means real estate, and it has to be similar in use. Buy other timber, buy land with timber, plant trees, or whatever it would happen to be. The IRS is pretty liberal about this, but it's not like an exchange where you can exchange a piece of rural land for an apartment building in town. It's more restrictive than that. You have 3 years from the end of the year in which you had the salvage sale to purchase that replacement property. And you're allowed to receive cash and then reinvest the cash. It's not obviously a property for another property. Talk about capital gains relatively quickly. The gains on the timber sale held for more than 1 year are subject to the lower capital gains rates, at least for now. I suspect y'all pay a little attention to what's going on in Washington, and all I can do is tell you what the law is in 2012. After that, who knows? If you're in the 0 or 15% ordinary tax bracket, and that means that if you're single, up to $35,350 in 2012, the tax rate is 0, which is nice. For a married couple, it's $70,700. You're in the 0 bracket. Otherwise, you're in the 15% tax bracket, and that 15% applies to net long-term capital gains. And I won't explain that in detail, but just be aware that when you fill out Schedule D, there's a new form now you have to use in addition to Schedule D, Form 8949, and you offset short-term gains and losses, you offset long-term gains and losses, you offset those against each other, and if you have a long-term gain as a result of all those offsets, then 15% tax rate applies to that. There'll be a rate increase in 2013. The 15% ordinary income tax bracket, instead of being 0, will be 10% tax rate, and if you're above the 15%, there'll be a 20% capital gains tax rate. And this is due to the fact that when they passed the original reductions in tax rates 10 years ago, it was sunsetted, and so things automatically are going to change in 2013. If you held the timber for 1 year or less, it's going to be a short-term capital gain. It's a short-term capital gain if it's a gain, which means you sell it on the stump. If it's sold in another way, then we have to treat it differently. So the capital gain rates applies to lump sum sales, fixed amount that you receive generally up front before the timber's cut, and there's also something called a pay-as-cut contract, which means you get paid according to the volume that's actually cut and sold to somebody. And you'll be really delighted to know that if you sell capital gains starting next year, you will be able to make a contribution to Medicare. And this is, again, this is only going to affect those up in the 1% bracket. There's going to be a 3.8% additional tax on the lesser of your investment income for the year and the amount of your adjusted gross income in excess of $200,000 if you're single, or $250,000 if you're a joint filer. And so folks that have significant investment income are going to be hit by this. Investment income is non-business interest, dividends, royalties like from minerals, other gross income from passive trader businesses. I will talk about passive trader businesses, the passive loss rules, if you ask me to. I'm going to avoid it because it gets pretty complicated. And net gains included in taxable income from the disposition of assets used in a passive trader business. So if you sold timber off your land and you are operating as a business and you're not materially participating in that business, then that gain is going to be subject to the Medicare contribution tax. If the timber is sold on the stump, it's held for personal use or for investment. If it's held 1 year or less, it's a short-term capital gain. It still goes on Schedule D, so it can be offset by other losses. And if it's held for more than 1 year, it's a long-term capital gain. If it's held as a business, there's a nuance here. If it's a business asset, if it's held by a business and it's held for 1 year or less, it's ordinary income. And it's ordinary income because of provision of the law that was recently changed. If it is held for more than 1 year, it is a long-term capital gain regardless of how you dispose of it, because of a section of the code called 631B. And if you happen to read any of the National Timber Tax website or my manual or whatever, you're going to see references to 631B. I don't know whether you do this out in your part of the world, but back here, if you have timber that is a relatively low value, poor quality, a small volume, the only way you can sell it is to sell it on the shares. And selling on the shares means that you and the logger sort of kind of go into business together, and generally the agreement is that the mill that's buying the logs is going to write a check to you and then one to the logger, and you agree on the percentage split ahead of time. But if you want to avoid that, then you need to have a written contract, although you should always have a written contract, that grants the logger a contract right to cut the timber on their own account. And that verbiage in quotes should be included in the agreement, because if you do that, then you get capital gains just as if you had sold that timber on the stump. If you sold the timber in a cut form, then, for example, logs, then you have to use another provision of the Internal Revenue Code called 631A, an election to treat the cutting as a sale. And rather than spending a half hour on this kind of transaction, I'll just say that there's two transactions involved for tax purposes. One is capital gains based on the fair market value of the stumpage that's cut, and an other one which is ordinary income from the revenue from the sale of the products less the conversion costs, minus the fair market value, which in essence becomes the cost of goods sold. So up here in the capital gains part, you would claim your allowable basis for that timber just like you would if it was a stumpage sale. A lot of folks ask me if, well, I don't have a basis in my timber, can I still qualify for capital gains? And the answer is absolutely yes. If there's no basis, the basis is zero, You take whatever the proceeds are minus the costs, and you pay capital gains tax on that. Going to quickly go through the recovery of expenses, and I'm going to be talking about folks that hold their property as a personal use, hobby, investment, or as a business. So in all cases, if you itemize your deductions or if you file a business return, you're going to get your property tax and excise taxes back because they're going to be qualified itemized deductions. All other expenses are either capital, the book value of assets that you acquire and you get your money back by depreciation or amortization in the case of reforestation. If it's an operating expense, then it's deductible currently if there is a profit motive and a reasonable expectation of eventually making a profit. And I'll talk about the hobby loss rule here in a minute. There's another category called carrying charges, which are expenses that could be deducted if your circumstances allowed or were accommodated that. Otherwise, you can capitalize them, add them to the basis of the timber generally. Hobby loss rule. If an activity produces a profit for 3 years in a consecutive period of 5 years, the IRS presumes that the activity is engaged in with intent to make a profit. The reverse presumption does not apply. If you don't meet this hobby loss rule test, then you have to show, based on the facts and your specific circumstances, that you're motivated to make a profit and you have the potential to make a profit, and you cannot do that without records. If you get audited, no matter how good of a salesperson you are, the IRS is going to want more than what you tell them. That was me taking a drink. But the beauty of timberland and real estate in general is that profit, for purposes of the hobby loss rule, includes the increase in the value of the assets that are used in the activity. Of course, that means that you know something about, you have estimates of the amount of increase in the value of the assets, because you have to be able to balance that increase in the value of the assets with the expenses that you're trying to deduct against that. So if your timberland is personal use, 10 acres, and you got a house and a barn on it, you can only recover the property taxes. If it's a hobby, you can recover the property taxes and miscellaneous itemized deductions, but only to the extent that you have any income from that property in that year. If it's an investment, you get your property taxes, plus you get other expenses recovered as miscellaneous itemized deductions at the bottom of Schedule A. And unfortunately, miscellaneous itemized deductions only add to your total itemized deductions to the extent that they exceed 2% of adjusted gross income. So I refer to that as a floor. So if you had miscellaneous itemized deductions from your timberland operation and you never made it over that 2% floor, they're not going to help at all. Of course, it's a business activity. They go on the business tax return. We're not going to have time today to talk about the forms of business, but they are discussed in the resources that are available. I'll refer to those in the end. You can only deduct an expense if it's ordinary, necessary, and reasonable in amount. And if we had more time, I would talk a whole lot about what's reasonable, because I get calls from folks that try to deduct expenses that you probably wouldn't believe. If your activity is a business and you do not materially participate in it, then any of those expenses that would otherwise be deductible have to be carried on your books until you have income from a passive activity. But fortunately, investment activities are not subject to the passive loss restrictions, so in some cases that's a major determination of whether you treat your activity as a business or an investment. Here's some good news. Reforestation expenses. You can deduct or take as an adjustment to gross income up to $10,000 per year for each qualified timber property. Trusts do not qualify. I can explain why if you want to email me someday, but I won't do it now. There's a big issue. This $10,000 per year deduction is relatively new, so what qualifies as a qualified timber property, we call them Q-tips, is up for debate. Some of my colleagues in this business say one person can only have one Q-tip no matter how many acres they own or whatever, but I say differently. In addition to the $10,000 per year, for example, if you had a reforestation project and you spent $15,000 on one Q-tip, you could deduct the $10,000 and then amortize the remainder. Trusts do qualify, as well as estates, for the amortization, and that amortization amount is unlimited. This is a really big deal. If your activity is an investment activity, you do not file a business tax return. Both that $10,000 deduction and the allowable amount of amortization that you can take are taken as an adjustment to gross income. They're not miscellaneous itemized deductions. And a lot of tax preparers find this hard to believe, but on the bottom of the front of Form 1040, down there on the last line where you have total adjustments, you put some verbiage in there about reforestation expenses, and you add that amount to your total itemized adjustments to gross income, and it reduces your adjusted gross income, which reduces your taxable income. So Congress wanted us to be able to take advantage of this reforestation benefit, whether or not we are a business, and whether or not we would be above that 2% floor on miscellaneous itemized deductions. If you get cost share payments, which you very well may do for fire protection and cleaning up your beetle damaged timber, if you get it from, you're going to get it from a state agency or a federal agency. If it's over $600, you're going to get a 1099-G. That, of course, goes to the IRS as well as to you. So when the IRS computers are cranking through your tax return, they're going to look for a match between that 1099-G and something on your tax return. The best deal, if you can do it, if the expense is for a project that's deductible as a operating expense, report that the amount of the cost share payment as income, other income, and then deduct the full cost of that activity, your out-of-pocket expense and the portion that's covered by the cost share payment. There is an exclusion provision in the Internal Revenue Code. It is an absolute nightmare to deal with. That's why this included in income and take the deduction is advantageous. If you want to use this excludable amount, you have to do a calculation, and the problem is that the excludable amount is based on the average income from your property for the 3 previous years. So if you have no income from the property for the 3 previous years, the capitalized amount that you get in the process of this calculation is going to be minuscule. So you'll only be able to exclude a small proportion of the cost share payment that you receive. Payments received under the Forest Health Protection Program, which many of you may be involved with because of the beetles again. Those payments qualify for this exclusion provision if you care to use it. I know I'm going fast and I apologize for that, but my purpose today again is just to highlight things so you'll know what to deal with when you get back home and seek more information on. Just out of curiosity, I went through some of the state tax websites in my reference library and looked at some of the tax rates. Looks like Montana potentially has the highest rate in the region. I didn't look at all the states that you all are from. Okay, we have about a half hour before we get into the question period, and so I'm going to delve into financial and estate planning. These plans, of course, should be based on the goals. The goals may be influenced by the possibilities, so there generally is an iterative process on establishing your goals and identifying how those goals are achieved. I want to make the point that there's a lot of paranoia out there about probate and doing whatever you can to avoid probate. If your estate is relatively small, there's an accelerated process for small estates, and whoever you name as the executor probably can take care of it all on their own. But if you are part of that 1%, then there may be a probate process. So you'll need to factor that into your estate plan. And of course, there are forms of ownership that provide automatic transfer outside of probate, like you and your wife have joint title to the property, tenants by the entirety, for example. Intergenerational transfers, lifetime through the estate, you can transfer it as is. If you have more than one heir that's going to be the owner of that property, there's sometimes too many cooks in the kitchen, and they can't get each other to agree on what the management program ought to be and when to liquidate some of the assets. And there's ways around that, like forming a business or using powers of attorney. If you are going to petition the property, divide it up into individual ownerships, that's fragmentation, and that's something where we, the public, the forestry community, is trying to avoid. Transfers during life. Under certain circumstances, those lifetime transfers are going to be taxable, but of course they do reduce the taxable estate because they're out of the estate. There's a lot of opportunities to do things in a fancy way, but there's a basic caution. If you want to get something out of your estate, you got to transfer almost all the rights in that asset. There's some exceptions to that, but you got to get it out of your hands, out of the estate. Federal gift tax. Of course, the purpose is to have folks giving everything away the day before they die to avoid the estate tax. It's based on the fair market value of the property on the date that you die. The maximum tax rate is 35%, which is a big deal. But there's an annual exclusion. You can give up to $13,000 of stuff to an individual, as many individuals as you want, per year, and you and the wife can give $26,000, and it's called a split gift, and if you do that, then you have to file the gift tax return. But even if you have a gift, an annual gift that's above these annual exclusions, you do not owe any gift tax until the total of these taxable gifts over your lifetime exceed $5.12 million, and 5.12 is for this year, and it's indexed for inflation. So unless if things stay the way they are now, that would increase next year. But I told my attorney when we did our estate plan that I want a plan that assumes we're going to go back to the $1 million excludable amount, because I don't trust Washington. 5.12 is a pretty high amount, so very few estates have to pay estate tax. This point here is about the unification of the gift and estate tax, and so when you settle an estate, that 5.12 applies to the taxable gifts over your lifetime and then the amount that's passed through the estate. I don't know of any state that has a gift tax in your region, but of course you want to check that out for yourself. You can make the gift as tenants in common, which means that each ownership interest goes to whoever's named in that owner's will when they die. Joint tenants means that a transfer is automatic to the other joint tenants. And one of the most common conversations we have with forest landowners is about forming a business, a corporation, subchapter S or C, limited liability company, or a partnership, so that you can use the annual gift tax exclusion to transfer ownership interests in these companies, in the business, without having to break it up. I see your question, Doug. I'll answer it when we get to the question period. A very common approach is to retain life estate in the surviving spouse. So the spouse has total rights to that timberland until he or she dies, and then there's a remainderman, a person that's named in your will that will receive the property after the surviving spouse dies. And there's a complication here, because there's something called a unified basis that applies to the life tenant and the remainderman, and I won't go into it in detail, but while the surviving spouse is alive, they have rights to the entire basis. So if they sold all the timber, they would get all the basis back. And then the remainderman gets whatever's left over in the way of basis from the activities carried on by the life tenant. I'm going to pass over trusts real quickly. I'll make this probably too broad statement that you can essentially do anything you want with a trust. Trusts are a way to accomplish almost anything, and they have to be carefully crafted, so don't even think about it without talking to an attorney. Moving on to the estate tax. It's an estate tax on the right to pass on assets that you owned on your date of death. And I won't try to explain where that logic came from. For most of us, it's not the primary planning consideration, because most family forest owners aren't in the 1%. And so here we're back to the $5.12 million in taxable gifts and assets that are passed through the estate. If it's less than that, then you're not going to actually owe any tax. Just quickly, why I think most of you probably don't need to panic about estate taxes, but you want to determine that on your own. In 2001, there was 108,000 estate tax returns filed. In 2009, there were 34,000, a rather significant reduction. And that's only 1.4% of the folks that died in that year. And of that, the 34,000, less than half owed any tax. And the total taxes paid were $21 billion, which in Washington I kind of think is chump change. So efforts to eliminate the death taxes, as they're called, a lot of folks raise their hands in holy horror because it's going to be a major revenue loss, but in 29 it was not. Returns from the gross estates of 20 million or more accounted for 58% of the tax paid, but only 3% of filers, so the 1% is up here in the $20 million estate value range, I believe. Federal estate tax. You estimate the value, fair market value of everything you own. You take off deductions for everything that you leave to your wife. Unlimited amount. There's an unlimited amount of charitable deductions, and then you take off the actual expenses involved in the settlement of your estate. You get a taxable estate. You look at the tax tables and get a tentative tax due. You reduce that by a credit, and that $5.12 million is actually referred to as the excludable amount, because you don't exclude that amount. It's just the equivalent amount that the tax credit protects from the tax. Marital deduction. This is really, really important. You want to make sure that the 5.12 million, or whatever it happens to be when you all die, you take full advantage of both of your 5.12 excludable amount so that you can pass the maximum amount of assets to the next generation. And for the marital deduction to work, your spouse, you have to trust her or him and give them complete rights to the property. The life estate is an exception, and there's some other possible exceptions. That third point, I mentioned that. I want to mention special use valuation. I referred to that briefly earlier, and the special use valuation is useful because it allows the value for estate tax purposes to be based on the current use, not the highest and best use. It applies to real property used in farming, including timber production. And there's the tax savings that's generated is recaptured if the business, it has to be a business, by the way, it doesn't stay in the family, or if the properties doesn't remain in a qualified use, and the maximum amount of reduction is $1.04 million in 2012. But if you're going to use it, you should include it in the estate plan so that the executor can be prepared to go through the process. There's also a qualified family-owned business interest deduction of up to $675,000. There's a bunch of restrictions on that. You can make installment payments of the estate tax if a significant portion of the estate is due to closely held business interest. Ruling from the grave. You want to keep the property in the family, for example. And you can do that with covenants, but those covenants can't run forever because of a legal principle known as rule against perpetuities. And in most states, the rule against perpetuities says that that covenant you might put in deed can only last as long as the lifetime of a person that's alive and named in the transfer. For example, the deed when you gift the property, plus 21 years. In other states like Indiana, the maximum amount of time is 90 years. This rule against perpetuity exists, and I think the logic is obvious, because as a society, we don't want folks that make decisions today restricting how property can be used 100 years from now when the conditions are totally different. Conservation easements are an exception to this. What I want to really emphasize about conservation easements is that it's a private contract. It's negotiated between you, the landowner, and some organization that's qualified to hold a conservation easement. So these contracts are negotiable, but of course these conservation organizations or governmental units are only going to get involved with you if they have a specific objective to accomplish with your property. Conservation easements come under state law, but there's also some federal law, Internal Revenue Code, that deals with the tax benefits. All 50 states have a provision for conservation easements, but the specific language has been changing over the years. Why do a CE? Because you want to continue the current use of the property in perpetuity. Perpetuity is a key word. You want to benefit your community. You want to reduce the value of your estate. You want an income tax charitable contribution deduction. And in addition, as an incentive for folks to sign conservation easements, there's a extra provision. 40% of the value of the eased land up to $500,000 can be excluded from the estate. I'm having trouble hitting that little arrow. Easements are enforceable, and the tax benefits apply only if it serves a public service. Preservation of land for outdoor recreation, education, or the general public, protection of natural habitats, preservation of open space, and historical structures. The contract specifies what the fee owner, the landowner, can't do. It doesn't specify what they it specifies what they can't do, not what they can do. So if it's not specifically excluded in the language of the conservation easement, you can do it. This is what I just said. But over the years, your children become the owner of this eased land, and they want to do something, and they don't understand what the conservation easement is, and the conservation organization now has a different perspective on the world. It could create problems. Development is the major restriction. Subdivide it and putting in houses. And for state law purposes and for tax benefits, the restrictions have to be in perpetuity. However, the property can be taken by eminent domain, and dramatic changes in circumstances that originally had justified the easement, the holder of the easement and the fee owner can go to court and have it changed, or the conservation organization can buy back the easement. The transfer of the interest in the conservation easement can be by sale, gift, or some combination. If it's a sale, it's taxable gain, capital gains. If it's a gift, it'll be a charitable contribution. There's some restrictions on total charitable contributions in any given year, but you can pass those on to later years. The value of the easement is the fair market value of the property. With and without the easement, there are major problems in getting qualified appraisers to come up with this change in value. In general, the value of the fee interest, that is the landowner's interest, is reduced, but not always. And especially in the West, there's been a whole lot of interest in the appraised value of conservation easements by the IRS, because there's some developers that buy 1,000 acres, divide it up into hundreds, and ease it, and they get some tax breaks, they think, on that, and the IRS is looking at those very closely. If you will put a conservation easement on your land, you can sell the land, you can give it as a gift, you can pass it through your will just like you would otherwise, but of course that easement runs through, runs with the title to the property. If you are going to put a conservation easement on the land and you expect the land's going to go to your kids, have the kids involved in the negotiation on the easement. Get them involved up front so they'll know what's going on and what to expect when they take title to the property. And you have to have a good relationship with the representative of the conservation organization, because they're going to come visiting every year or so to check on how things are going on your land. There's some states that have a state estate tax, but because of a nuance in the federal tax law, those state estate taxes generally don't apply. There may be an inheritance tax. An inheritance tax is a tax that's paid on the right of the heir to receive the property. And in the way of references, I'll refer first to the National Timber Tax website. It's the product of the U.S. Forest Service. Mark Kuntz from Meridian, Idaho, and I originally created it. We haven't been involved with it for the last 2 years, but it's very useful. There's really nothing on there with regard to estate taxes. A little plug for Timber Tax Management for Family Forest Owners, which is a manual, quite comprehensive manual that Mark Kuntz and I write every year, and it's available at that website. And there is a program, absolutely outstanding program, produced by Oregon State University. It's called Ties to the Land, Keeping Family Forests and Farms in the Family. You can buy the materials at this website, tiestotheland.org, or ideally you're going to go through a facilitated workshop. It's much better to do it that way. And there's estate planning for family forest landowners. What will become of your timberland? This is a U.S. Forest Service publication available online there. And the only trouble with it. It's very good. It's outstanding. It's written by a Forest Service employee that's retired. That's an attorney, Bill Siegel. And but it's not updated annually because of the Forest Service publication process. And I think I may be a little ahead of schedule, but let's start taking questions. And you're going to type those into the chat box there. Doug Hoff wants to know, can we deduct cost of removing mountain pine beetle trees, and is this cost added to the basis? Interesting question. Ideally, it would be a deductible expense, and you're going to want to justify that you had to do this removal for sanitation purposes, trying to protect existing trees, that it's an ordinary and necessary activity that's being carried on in your part of the country. If you can't deduct it, then I would add it to the basis. It's going to be a carrying charge, and you're going to have to file a plain piece of paper, Form 3P, that specifies that you are electing to deduct these expenses that would otherwise be deducted on your tax return for the year. Bill Carpenter, is this webinar being recorded and available for later review? I can't answer that question. Lindsay will when we end here, I suspect. I'm still good for a half hour if you have more questions. If I was there live, I would be asking you questions. Yes, it will be released next week. Well, we're waiting for more questions. I'll talk briefly about forms of business. For tax purposes, you almost always want a business that is a pass-through entity. You don't want to be a C corporation. If you do incorporate under state law, you want to be an S corporation. If you otherwise, you're going to be an LLC or a family partnership, and again, it's the pass-through benefit. If a landowner has a timber sale and doesn't receive a 1099, what should they do? Pay tax on it. The IRS figured out about 6 years ago that there's a whole lot of folks that sell timber, get money, and don't report it on their tax return because they weren't getting a 1099. The law has always been that if you have a pay-as-cut sale, those payments are considered a royalty, and the person that's cutting the timber has to file a 1099. But of course, a lot of them didn't. So if you don't get a 1099, just report it on your tax return. If at all possible, take it as capital gains and try to recover your basis. We are considering doing a timber sale on our cropland. How long before this sale should we be tracking expenses? We are considering doing a timber sale on our cropland. I kind of lost on selling timber off a cropland, I guess. It's a farm, a ranch that has cropland and timberland. Tracking expenses for purposes of the allowable basis is different than tracking expenses with regard to being able to deduct each year your operating expenses. The only expenses that would affect the timber sale itself would be those that have to do directly with the timber sale or are added to the basis of the timber. So the real answer, Ann, is to figure out what the basis in your timber is, if you can figure that out. It's corporate land. The basis in corporate land is going to be different than the kind of bases that I talked about, and so I'm not going to be able to address that in any detail. You're going to need to talk to your tax preparer, but my basic comments about the basis and about operating expenses apply to the corporation. My family owns land in a family partnership. To minimize the benefit of timber production, should we form an LLC and run the process through that? No, most LLCs are taxed as partnerships. There's no such thing as an LLC tax return. The first year that your LLC files a tax return, you're going to make an election, and in almost all cases, you're going to elect to be a partnership. I hope I've answered that question correctly. My family... If it's a legitimate partnership, that shouldn't be necessary to form an LLC. Unless you want to transfer interests, and it's easier to transfer interests with ownership interests if it's an LLC. Can timberland be put into a CRP program? It has only been grazed, never cultivated. Based on what I know about the CRP land, at least in Indiana, it has to be highly erodible soil. If it's already grassland, you're not going to be changing its use. So I think my answer to that would be no, that it would not qualify. And it's also my understanding that in your part of the world, if there's tillable land, it's even if it's under a CRP, it's being converted and put into corn or wheat or whatever it's suitable for. So, John, the answer is no. But you may want to see if there's some variance in your particular soil and water conservation district. Al, let me talk about reforestation. If you sell the timber off your land because of beetle kill, and you want to reforest it, you want to take advantage of the deduction and the amortization. And if your circumstances are correct, you can have more than one Q-tip, so you can have more than one $10,000 deduction in a given year. So, for example, if you have two different properties that are not beside each other, you could probably treat each of those as a qualified timber property, even though there's only one taxpayer. That $10,000 for a married couple is, and you file separate returns, that's split between you. How does the impact of mining activity in timberland affect the taxable basis of the timberland? For example, the mining activity requires timber harvest, but this may be before the trees are mature. Can this be treated as a loss? No. If you have a basis in that timber, and what you get for the timber, if anything, or you get nothing, then you will have a loss instead of a gain. And because it's a forced sale, it would qualify as an involuntary conversion. And remember, I talked about Form 4797 and buying replacement property, but it's not going to be a casualty loss. It could be a business loss. Can a large contiguous property be treated as more than one Q-tip? Gee, I just was addressing that. What I'm telling folks is that if you have a large property and you have separate stands, and they're different, the soil's different, the terrain is different, you're managing them in a different management program, then I would argue, and this has not been tested in court, that you should be able to treat each of those stands as separate Q-tips. Are thinning expenses to our land, would they be considered a valid improvement? A thinning is most certainly a valid improvement. You don't say whether you're getting money for the thinning or it's an out-of-pocket expense. If it's an out-of-pocket expense, you can deduct it currently if you're a business or you want to do the miscellaneous itemized deductions, or you can treat it as a carrying charge, which means that you file that Form 3P, plain piece of paper, saying you elect to amortize these expenses to my timber account. I'm having trouble reading with the moving thing. To be included in the cost basis. Yes, Ann, that's, I think, what I just addressed. Can cut logs, dimension lumber qualify as a capital gains? Doke. Remember I talked about 631A election, and I said there's two transactions. There's a capital gain on the difference between the fair market value of the trees that you cut to produce the logs on the last day of the taxable year, and what your basis in the timber is. I think I said that wrong. It's on the first day of the taxable year in which the trees are cut. So you get that fair market value, even though it's totally hypothetical. You subtract off your allowable basis and whatever cost you might have had to mark the timber or whatever, and that is a capital gain. It's probably going to be a long-term capital gain. Then you have your dimension lumber business or log business, and you sell the logs, which is business revenue. You subtract off as a cost of goods sold the fair market value of the timber that you harvested. Then you subtract off whatever other costs you have. If you're not already a business, Doke, you may, and you were audited. Of course, if you don't get it audited, it's not a relevant issue. You got audited, they may question whether or not you qualify to use 631A. Elect to treat the cutting as a sale. Okay, out-of-pocket expense for Ann's thinning, and yes, it can be deducted, or it can be capitalized to the timber account. And a lot of folks are taking it as a carrying charge and adding it to the basis of their timber. The estate, John, the estate exclusion in 2012 is $5,120,000. That, what I referred to in my discussion, is for 2012. In 2011, it was a $5 million even. The issue is what it's going to be going forward, and there's still a lot of folks trying to eliminate death taxes, but I don't hold out much hope for that. So talk to your attorney or your estate planner and see what excludable amount it would make sense for you to use in your plan based on the size of your estate and where you want your assets to go. So the short answer is $5,120,000. You're welcome, Doug. Do you foresee any liberalization of capital gains treatment in the future favorable to timber treatment prior to 1986? I've got to reflect back on 1986. In 1986, we didn't have a zero tax rate on capital gains for those in the 15% tax bracket or below. All the other capital gains provisions still exist. In fact, they're a little more favorable because of the change in 631B. If it's timber owned by a business, you don't have, and you sell stumpage, you don't have to do it with a pay-as-cut contract to get capital gains now. So I think the big worry, Dennis, is increases in the capital gains tax rates that may occur. How can you establish basis 20 years after the land was purchased? What are all the alternatives? You want to look at the potential benefit from trying to establish the basis. The cost of doing that in today's dollars versus what the values of the land and timber would have been 20 years ago. Frequently, because of inflation, the potential tax benefit is less than what it would cost you to do it, because you got to hire a consulting forester, or if you're a forester, you got to grow those trees in reverse, figure out what they were like 20 years ago and what they were worth 20 years ago, and then you have to get an estimate of what the fair market value of the land was 20 years ago, and you have to go through the same process that I described as if you were doing it in the year that you acquired the property. So it can be done, but it can be very challenging and it may not be worth the effort. What are the requirements for demonstrating the value of timber? Stumpage. Should a fire consume the timber? This timber today is virtually worthless given the Neiman monopoly, but selling the timber to markets outside of the hills provides the landowner with an argument for a much higher value. Okay, selling it for a much higher value, even with the transportation costs. If the timber is destroyed, it has no value. You can't salvage it. You can't do anything with it. Its value is zero. So you're referring also not just to that, but to how to estimate the fair market value of the timber before the fire. And this is an appraisal question. The IRS has guidelines about appraisals, and you can use the best market that is available to you to determine that fair market value, but it has to take into account all the costs that would be associated with that sale process, the transportation costs. It's got to be what it would be worth if it was sold on the stump to the buyer that's willing to come in and buy it and harvest it. That wasn't a very good answer, John. You can ask me a question again if I was not clear. Yes, even with transportation costs, shipped by rail to the Midwest. If you can sell it that way and it has a fair market value based on that, yes, it's you appraise it at its highest and best use, at the best market that's available for it. It doesn't have to be sold locally. We have a lot of log home builders back here that get logs out your way. There have been many efforts over the years to try to get Congress to change the law with regard to casualty losses to timber because a lot of folks are losing everything they have and have no tax benefit at all. How do we determine highest and best use? You determine it through an appraisal process, and you look around what's going on in the neighborhood of the property, and if you put it on the market and somebody would bid on it for development purposes, then that's the highest and best use. So that's why I emphasized earlier today the importance of working with a qualified real estate appraiser. Okay, let me see. The highest and best use. I can sell on a cord basis to buyers in the Midwest. I'll use that basis should the unthinkable happen. Well, I hope it doesn't happen, John. I don't think I've heard of major fires in your part of the world. This Mark Kuntz up at Meridian, Idaho that I work with is at the Interagency Fire Center, so he keeps me apprised of what's going on in the fire world. Since we have a pause here, I might mention that last summer my wife and I followed the Missouri River down through North Dakota and South Dakota and went over to Crawford, Nebraska, and stayed at the High Plains Homestead, which was fun. Had a great meal there. How would payments through the federal tort claims process be treated for tax purposes in the recovery of damages? I'm going to have a hard time answering that in a way that I'm comfortable with, Greg. In some circumstances, it's a taxable income. In other circumstances, it's not. I think it depends on whether or not it's for damages. If it's for damages, then my recollection is that it's not taxable. If it's compensatory or beyond the value of the property that was harmed, then it's going to be ordinary income. It was interesting driving down along the Missouri River. To stay close to it, we had to go on some gravel roads, which my wife wasn't real happy about. And the river looked like a lake. I think we're done. Thank you all for joining me, and have a good weekend. Can someone still on the webinar answer Greg's question? I have no idea about treating trees to prevent beetle damage. We're treating trees back here for the emerald ash borer, but it's horribly expensive unless it's a really valuable shade tree. We don't even think about recommending it because it's a systemic insecticide that's injected into the trees, and it has to be treated every year. Yes, I'm sure it's expensive, because if you don't inject it, I suspect you're going to have to do aerial spray, which is going to require permits and going to be challenging. I think it was Bismarck we went through on our trip last summer, and I asked somebody on the street there if there was a good market for used sandbags, because there were sandbags everywhere, and apparently the water never got up high enough that they were needed. But it sure looked like a lot of work. When would it be better to capitalize management expenses rather than deduct them as soon as possible? You would capitalize them only if they're not capital costs to begin with. You would treat them as carrying charges if they're not capital costs to begin with. If they're capital costs, they have to be capitalized. But if they're operating expenses that would otherwise be deductible, you can elect to treat them as a carrying charge, capitalize them to the timber account, because, for example, you're treating your activity as an investment, and those expenses would be reported as miscellaneous itemized deductions. And if you don't itemize, it's not going to help. And if you don't have other miscellaneous itemized deductions that already get you above that 2% floor, then those the management expenses are going to be using up part of that 2% floor before they add to your total itemized deductions. So that's the basic situation. Maybe those sandbags can be turned into I own some property back in Pennsylvania, and they are fracking the heck out of it. You've given lots to consider. I own an old Boy Scout camp, which is also a lot of work. I'm on the board for a Boy Scout camp, and I know exactly what you're talking about. Do you post your email for later questions? Oh, yes, absolutely. I'm not certain my email is appearing. It's whoover@Purdue, PURDUE.edu. whoover@Purdue.edu. Thank you, Lindsay. Ah, the thousand canker disease. The furthest east that it exists is in Tennessee, and I believe there's someplace in Virginia maybe. But what we're hoping is that all of the instances where thousand canker disease has appeared have been in urban settings. So far we've not found it in native woodlands, and we have our fingers crossed that for whatever reason that the walnuts in native woods will not be susceptible. But you're asking about plant plantations, and if it's an isolated plantation in a area with open fields, it may be subject to it. So we're having a lot of discussion about that. Yes, indeed, it's in the Knoxville area, I believe. Are you the Dennis Adams in the Walnut Council? I assume you are. I figured there must be some connection. We still have folks that are interested in putting in black walnut plantations. We have a Spanish company that's got, probably 500 acres of walnuts and other mixed hardwoods south of West Lafayette here, and I'm sure they're carefully monitoring it, and given the intensive management they're using, that they would be willing to spray if the beetle, I believe it is, was found. Dennis, can you help with that? A map showing the bark beetle? I saw a map somewhere. I Googled that, and it showed it just coming into western Nebraska and South Dakota, of course. I think if you Google a mountain pine bark beetle map, there's one will come up. The Forest Service has put one out, I believe. An authoritative map. I would assume that your land-grant university would be tracking the beetle, and they may be, at least to your way of thinking, more authoritative than the Forest Service. It's my understanding that so far the Walnut Council and others interested in the thousand canker disease haven't been able to get APHIS involved at all. I assume because they don't think anything can be done, and I don't know what involvement APHIS has with the mountain pine bark beetle. I suppose none. I saw on a website recently that prescribed burns were being used to control the mountain pine bark beetle. That would be an interesting approach. I guess would have to be done at the right time while the beetles are still breeding. The South Dakota Department of Ag. I'm sure they're authoritative. Transfer to the Midwest. Oh, that's always a possibility. I think the beetle is endemic in the Midwest. It's just not gotten epidemic yet. I didn't do very well in my entomology course when I was in forestry school, and there's so many different pine beetles that I may be thinking of one other than the mountain pine bark beetle. Clearly, if the beetle requires mountains, it's not coming back here. Okay, uncontrolled burn in northwest Nebraska. I think there's a few natural barriers, aren't there, in northwest Nebraska? I get to help with the controlled burn of a prairie at the Boy Scout camp I had planted in part to a prairie. That's always exciting. Wisconsin Department of Ag doesn't agree with you. They are going to issue a quarantine next week. Okay. Well, they have a lot more pine up there than we do down here, so I think that's understandable. I assume that there's no sanitation certificate that can be issued because of how widespread the mountain pine bark beetle is. The Pine Ridge area, okay. Do you know, John, if Wisconsin has found the beetle in any of their stands? We take our students up to the UP and into Wisconsin every summer for our summer field practicum. I understand what Wisconsin's doing. That EAB is We're just assuming that there will be no ash trees in Indiana 20 years from now. BeatTheBeetle.com. I'll have to check that one out. We always try to get out to Colorado because I love the Rockies. And the first time I went back, I just couldn't imagine. I had no idea how bad it was. I go back to Saratoga and Encampment, Wyoming, where I work one summer, and that's unbelievable. Well, we're going to make another trip west this summer, so I'll try to get through the Black Hills again. I haven't completely explored them yet. Yes, very sad. I worked up on Black Hall Mountain that summer, and it looks like it's totally devastated. I did see some natural regeneration, however. Maybe someday we'll figure out what all that mortality is due to in the lodgepole. In 3 years, we have had around 1,000 trees hit in 60 acres in the Wrist Canyon, Colorado area. 1,000 trees, 60 acres. So I assume that wasn't everything. Is there a beetle-resistant tree which could be replanted, and at what cost? Are you doing sanitation, Don? Could somebody answer Greg's question about an alternative tree that's beetle resistant? Even the aspen's having trouble these days, so, and of course that's just in the lower areas. Sugar maple, well, that's an interesting possibility. And we will end the session to allow for discussion. Okay. Black locust. Oh, didn't know that was common out that way. I guess we're cutting it off. Sugar maple and pine ridge? Yes, that was my question. Are we done, Lindsay? Lindsay says we're done.